Welcome, everybody, to the afternoon session of the China Conference. We hope you had a good lunch. What we'll be doing this afternoon is journeying from the domestic economy, where we focused much of our time this morning, to the international economy. I want to thank my co-organizer, who cannot be with us today, Barbara Stallings, who's teaching in China, but helped plan both of these panels this afternoon. The first panel on the BRI, and the second panel on China's trade integration globally. So within this panel today on the BRI, we'll be looking at the course of the BRI over the course of the last 10 years. This, of course, is one of China's key foreign policy initiatives in infrastructure financing. A key element, in addition to it being a key initiative, is it is rather big umbrella, amorphous kind of program. So the challenge that we've given sort of our speakers today to some extent is to look at, okay, well, how has this program developed over the course of the last decade? And so you'll be hearing a variety of viewpoints. We'll be hearing, for example, of China's learning process with the greening of the WTO by Rebecca Ray, who's a senior academic researcher with the Global China Initiative at Boston University, also a former MA student here at GW. And she also has written on the topic of global governance from an environmental perspective within the Latin American region, such books as China and Sustainable Development in Latin America. We also, from the Chinese perspective, have visiting scholar at IIEP here, Muyang Chen, who's also an assistant professor of international development at Peking University. And she has a new book out on the topic she'll be talking about, which is development finance. It's called The Latecomers Rise, Policy Banks, and the Globalization of China's Development Finance with Cornell University Press. Finally, we have the US perspective. Charles Kenny of the Global, he's a senior fellow at the Center for Global Development. He's authored books such as Getting Better, Why Global Development is Succeeding, right? And he'll be talking to you about the US reaction to the BRI. He's also contributing editor at Foreign Policy Magazine and Business Week. And finally, our fearless discussant leader today will be Miles Kahler. He is a senior fellow for global governance at the Council on Foreign Relations, also a distinguished professor at American University, and recently received from the ISA a Distinguished Scholar Award. And one notable thing about Miles that was mentioned is that he's always sort of out on the cutting edge of issues throughout his career, both writing, analyzing, and publishing. And so he's a perfect person to lead us through this burgeoning terrain as well. So thank you very much. And we'll first call up our first panelist, Rebecca Ray.
Well, thank you very much for that, Stephen. For that introduction, I was just realizing, I think the last time I was in this room was 17 years ago when I presented my IDS capstone project to graduate from the Elliott School, and how cool it is to be back, and what an awesome group of panelists to get to present with these three different intersecting perspectives. I think we'll have a lot of common ground, though, as we're looking at the same phenomena. Thank you very much. So we're at 10 years of the BRI now, and I'd like to think with you some about changes that it's undergoing in order to maximize benefits and mitigate risks, both for China and for host countries, from an economic, environmental, and social perspective. So first, I may just click a button. Yes. First, I'll go through some trends up for the last 10 years and the impacts environmentally, socially, and economically, and how China is pivoting to take better care of risk management and to maximize those benefits, as well as prospects for institutional changes that we might see on the horizon and how that might change the kinds of projects and sectors that China is engaged in. So a few takeaways, the 50,000 foot perspective is that the BRI has brought significant economic benefits to host countries, developing countries around the world. However, it has also accentuated conservation and climate risks, which not only are risks for host countries and communities, also are financial risks for China. And so, in the last few years, Chinese DFI lending, the lending from their development finance institutions, particularly the China Development Bank and the Export-Import Bank of China, has fallen significantly as China's undergoing an institutional evolution in its governance of the BRI. So at the end, we'll talk about this currently underway development of the green BRI. What does it mean? What does it look like? What are the priorities? And what kind of results can we expect? They're still being created now, though. So it's our job to track this as it moves forward. So first, some trends. When I talk about development finance, this is an area in which China is obviously, as everyone in this room knows, the #1 bilateral development lender in the world, but it's also very much a relative newcomer in this space. So here we're tracking PPG, sovereign lending, so that is public and publicly guaranteed. Government to government loans or government to government guaranteed projects from the last business cycle peak in 2008 through 2021, compared to the World Bank, which is in blue. So this is billions of dollars in new commitments. And as you can see, especially during the first 5 years of the BRI, from this down, we have the global financial crisis when China was asked to step in and provide additional financing by host countries globally. And then the announcement of the BRI startlingly shock upwards, and then an equally steep shock downwards after 2016, whereas the multilaterals like the World Bank could continue to lend proactively during the crisis year of 2020. Over here, we see the sectoral difference. And of course, the difference is stark. The majority of World Bank lending is in this blue column right in the middle. That's public administration. That's where you see the soft infrastructure of institutional capacity building, human welfare programs, whereas countries are going to China primarily for lending for infrastructure and industry. Given this, now the totals aren't that different though. China's total commitments during this time is 83% of what the World Bank committed. So about $500 billion, which is far and beyond, far and above what a whole different level than any other country in the world issuing national development finance. So given that countries are going to China and the World Bank for vastly different kinds of projects, it's not startling that the same countries are going to both. Countries are not choosing between China and the West. Developing countries are choosing to go to China and Western development finance institutions for different kinds of projects. Or as Chris Humphreys at ODI says, shopping for development. You don't buy your bananas at the hardware store. You don't buy your hammers at the grocery store. You go to both stores for different kinds of projects. So here we have countries in the world who have borrowed either from the World Bank in blue or from the Chinese DFIs in red during this time, and or in between, what share of their PPG borrowing has come from each. And as you can see, there's 100 countries who have borrowed at least some from China during this time. 72 of those have either borrowed about the same from each or more from the World Bank. So China's clearly just another option in the portfolio of options. I have 4 countries in particular highlighted here who are among China's top borrowers. You can see all 4 of those countries, Brazil, Argentina, Pakistan, and Bangladesh, are right in the middle. Right, so even some of China's top borrowers see China simply as another storefront for development finance, not as an alternative. What has been growing, though, since 2016, we've seen this massive plummet in finance. What's happening to equity? Equities continued to grow. These are overseas development investment funds. You've heard of the Silk Road. There's the African Fund, the Latin American Fund, and others. These have continued to grow to a capital of $155 billion. For scale, the IFC, the equity window at the World Bank, has, at the end of 2019, capital of $28 billion. So the scale of this is not to be underestimated. The fact that we don't have databases about the specific projects that are being supported does not mean we should undercount this pivot towards equity. It's really important. And then finally, China's participation in liquidity arrangements. The 6 largest central banks have unlimited currency swaps among us. So it doesn't affect the EU that the US dollar is trading at historically high rates, but for most of the countries in the world, this is a significant bottleneck. Just in daily exports and imports, the payments of debts that are denominated in dollars, you have to get a hold of those dollars. So China has contributed about $900 billion to a system of currency swaps. These do not add to debt. They are not development finance. They are liquidity arrangements among central banks, either through bilateral swap arrangements, that's $570 billion, or about the amount of total development finance, or through the Chiang Mai Initiative multilateralization, or the BRICS contingent arrangement. So we see China pivoting its modes of engagement as the needs change and as risk changes. But let's think about impact for a moment. This slide thinks about impact from an economic standpoint. Overall, it's been well established in the literature at this time that Chinese development finance is associated with economic growth in borrowing countries, whereas World Bank finance is not. That's not surprising. We saw the sector distribution. Soft infrastructure is crucial for long-term development, but it's not associated with near-term economic fiscal multipliers the way building a highway is. Of course, that much is not shocking. We've also seen emerging literature explaining that the underlying natural capital that supports economic activity through ecological services is actually associated the other way. We see negative rates of, or depressed rates of growth in natural capital accumulation thereafter. Debt, obviously a part of the conversation here. We have comparing 2008 to 2021 PPG debt from EMDEs. This is all EMDEs. And this is EMDEs in debt distress or at high risk of debt distress, either according to the IMF and World Bank Debt Sustainability Analysis or UNDP analysis. In both cases, you can see that the total PPG debt has nearly tripled since the last economic crisis year. This is a sector that has absolutely exploded in size as an issue and is an emerging crisis around the world. We have it differentiated by color according to who the creditor is. So China's in white here. You can see it's a part of the story, but it's not the story. It's not even the story regarding EMDEs who are at risk or in debt distress, which is not to say China doesn't need to be at the table. China needs to be at the table with all of the other major creditor categories. But as I said earlier, most of these countries are borrowing from China and other sources at about the same rate. It's not unique in that way. However, environmentally and socially, the impacts are unique. Using precise geolocation of Chinese DFI projects, we can compare the risks to biodiversity and to indigenous lands for each of these groups across sectors and overall. And we see significantly higher risks in both categories associated with Chinese lending, not just overall, which you might expect, because the World Bank isn't lending to as many highways through the forest, right? They're not lending to as many hydropower projects, but even within those sectors, even within energy and extraction, Chinese lending is associated with higher risk. And that is risk for China as well. So there's new literature showing that Chinese power plants overseas, for example, are significantly more likely to have cancellations, suspensions. These are costly both in terms of diplomatic and economic goals if they carry significant environmental risks to local communities. If they are coal plants that have significant particulate matter air pollution associated with them, hydropower plants that have significant flooding of local communities, that's a risk to China. It's not just a risk to host countries, it's a risk for everyone. But these risks are mitigated significantly when Chinese DFIs co-finance with other DFIs. So this is really a story about young institutions who are new to the development finance space, learning from their peers. A few years ago, we put together this table in conjunction with colleagues at the Ministry of Ecology and Environment in Beijing, looking at the institutionality of lending. MAE likes to talk about whole life cycle project governance. That's not a new phrase to those of you who are in IDS here at the Elliott School. We think of 4 stages of project implementation from preparation all the way through completion. We can compare Chinese DFI policies to their peers, national development banks, either in Asia or Africa, or Asian regional development banks. And we can see that Chinese DFIs simply haven't developed the policies yet. They're still developing them, right? There's these large holes where there's work ongoing right now. And that's what I want to talk about next with prospects. In my last few minutes, we can think about the BRI in 3 time periods when it comes to environmental governance. The first 5 years, BRI is lending. We're seeing huge numbers in that lending graph I showed you at the beginning, where host countries are seeking out Chinese financing for rapid deployment of large-scale infrastructure with high fiscal multipliers, getting shovels in the ground, getting people working, getting something delivered to the voters before the next election. Frequently, in the sector of relatively cheap fossil fuel power. No discussion of a green BRI whatsoever in these years. There's some, but almost none whatsoever. The next few years, we start seeing results come in from these projects. We see China facing international pressure to green its portfolio. We see host countries dealing with the social, environmental, and economic risks associated with these early institutional stages of simply not having the due diligence processes in place yet. And so China begins issuing green BRI regulations in a reactive way as problems may emerge in some places. Since the pivot year of 2000, now we've seen a proactive engagement, proactive development of a concept and principles, and now beginning to be practices of a green BRI. In part, this is because developing countries are facing the reality of climate change and the reality of the technological and investment gaps that they face in order to be ready for it. Here's what that looks like. I'm not going to go through all of the reforms, but I do want to point out that before 2020, we have reforms that are relatively general. We have opinions, we have principles, kind of general concept publications from MEE, often, sometimes in conjunction with more powerful ministries like MOFCOM or the NDRC. Beginning in 2021, now we see real change starting. This is when Xi Jinping goes to the UN General Assembly and says, no longer will we support coal-fired power plants overseas. We will instead support renewable energy overseas. We see the State Council beginning to talk about biodiversity. One might think this is not out of their history. No, this is embracing a new era in which China can lead on this front. 2022, one of the most interesting things that's come out is the National Financial Regulatory Administration, which used to be called CBIRC, put out green finance guidelines that say that all finance institutions who operate abroad need to come up with community consultation and complaint mechanisms. These are directly these gaps right here. That's these gaps specifically that we had lined up in our project with MEE a few years ago. Not taking the credit for that, obviously, it's the state of China. In 2023, last fall's Belt and Road Forum, we see the announcement of the GIFP, the Green Investment and Finance Partnership, which is developing a pipeline of projects. Because again, if we go back here, this is this project preparation stage. How can you scale up renewables if there aren't any projects waiting to be financed in Africa for wind and solar? How are you supposed to step into that as a lender when the entire MO has been lenders coming to you with their ideas? So that's what the GIFP is. It's brand new. We'll see what it does. And then finally, some results. It's perhaps easiest to measure the results looking at coal as a part of China's overseas power plant portfolio, where we have gigawatts of capacity by fuel type. So you can see that those that are already in operation, coal is the most important fuel type. Those under construction, it begins to wane in importance, and those under planning, it's no longer the largest sector. So we are in fact seeing that those projects that were already in the pipeline when Xi Jinping made that announcement, they're continuing to move forward, but China really is pivoting towards not planning new ones. When we look at solar and wind plants, these are much smaller levels of gigawatts. Clearly, they're starting from zero. 2021 is when that announcement was made that China was going to beef up renewables support. 2016 down here is when overall lending peaked and started declining very, very quickly. But these sectors, it's actually accelerating in. What's still remaining as the bottleneck is simply creating the pipeline of projects that they can easily support. And that's where the GIFP comes in. We don't know yet what the final form will look like. We don't know how many projects it'll be able to support, but that's exactly what we'll be tracking over the next several years as hopefully it becomes a reality. If I get to share these slides, if anybody wants them, let me know. We've got all of these papers. Be happy to share all of these graphs in their original form. Otherwise, thank you very much.
Thank you. I guess everyone can hear me well. So thank you very much, Stephen, for organizing this wonderful panel. And I'm very happy to discuss development finance with a great audience here. So the topic, the title of my talk today is Development Finance as a Crossroads. As Stephen has introduced, actually, this will be part of my, oh, is it working? Maybe I'll just use, I'll use this instead. So this is actually part of my forthcoming book. I'm first going to show you some data. Okay, so this data from the Global Development Policy Center and also aid data. So these are the two existing data set that try to capture China's overseas development finance. The calculation is slightly different, but if you look at the general trends, you see that the Chinese overseas development finance volume kind of peaked in around 2016 or 2017, right? And then you see some kind of decline. And there's been a lot of discussion as to what leads to this kind of decline and what really is happening. In my book, I'm not trying to establish a causal relationship, but I want to provide some kind of answer to that. So this book focuses on China's two policy banks. Policy bank is specifically the China Development Bank and the Export-Import Bank of China. So as their name suggests, policy banks are banks created to serve policy goals. So they are different from, for example, commercial banks that pursue market profit maximization. But I also want to understand China from a comparative perspective. So China is not the first country that created this kind of financial agency, right? Broadly speaking, we have this so-called public financial agencies in almost every country, right? So in this book, I try to understand, is Chinese development finance really unique? Like, is it something new that China has been doing, or it's just a general, latecomer? So to understand that, let's first take a look at just in case you're not familiar with China's financial system, we can take a look at what are the financial agencies that are supporting overseas development project. So what I just said is Exim Bank of China and then China Development Bank. So they are kind of like similar to what OECD country would term as export credit agencies, right? For example, the United States has the US Export-Import Bank, which is the export credit agency. But in addition to that, we also have aid agency. For example, USAID is an aid agency. And in China, there is the CCAT, like China's official aid agency. But please be aware that the aid agency's funding source is just fiscal revenue. But the policy banks, the majority of their funding are actually self-raised funding. So which is slightly different. And then we also have Sinosure, which is the official creditor. It's also another type of export credit agency. And then in addition to that, there are many Chinese commercial banks. Some may argue that most large Chinese commercial banks are actually state-owned. So in China, there's not much of a clear division between like state-owned versus private-owned, because most of the banks are state-owned. But there is a distinction between policy banks versus commercial banks. Right? So the bank's mandates are different. So all of these financial agencies support overseas development finance projects. And of course, due to their financial mandates, their roles are very different. So my focus is these two. This is mostly because these two are the largest two banks from China. And they are also the largest bilateral creditors, if we put them on a comparative perspective, that are supporting developing country projects. Okay, so how do we understand these policy banks? As I said, there are major two categories: aid agencies and export credit agencies. Many people would see these two as similar agencies like aid agency, but in fact they are not. But they do support projects similar kinds, like in lower income, middle income countries. So here I listed their international counterparts. They are most well known. For example, a French aid agency would be something similar to an aid agency. And Japan's Nexi would be something similar to an official insurer. But the Chinese policy banks are most likely something in between, right? In terms of where they finance, they're kind of similar to aid agencies. But in terms of how they finance, they're actually more similar to export credit banks or export credit insurers. So that's slightly the difference. So how do we compare Chinese capital versus, for example, OECD capital or G7 capital, broadly speaking? So here I would like to highlight, the special features of public financial agencies. These agencies across countries, they all face this dilemma, that is state or market, right? So on the one hand, they are financial agencies. So at least they have to keep a financial balance and not losing money, right? But on the other hand, they are created to serve publicly oriented goals, right? But do those two different goals always align with one another? The answer will be definitely no, right? Sometimes, firm has some interest, but that doesn't necessarily align with the state's interest, right? So all of these public financial agencies, including Chinese policy banks and other countries' public financial, they have to suffer at one time or another, right? So how do OECD countries deal with that? So there's a long history of how OECD public financial agencies have evolved. I can talk more in detail in the Q&A session in case someone is interested. But just to briefly say, OECD rules separate aid from export finance very clearly. The rationale is very simple, because if you use aid to support export, that is a kind of subsidy, right? And it violates the fair competition, right? Commercial banks will be unhappy if they are competing with the export-import bank, which receive some kind of state support, right? So that's the OECD rule, right? But for catch-up economies, not just China, I see, like, for example, Japan in the 50s and 60s as well. For catch-up economies, there is a tendency to combine these two, right? In OECD terms, this will be, for example, tied aid. The aid finance is used to support national firms' overseas business expansion, right? So there is a kind of blurry line, between aid agencies and export credit. Throughout history, if we look at Japan in the 80s, Japanese JICA or JBIC, Japanese Exim banks, they have suffered that. US, German, for example, in the early 21st century, they suffered that. And then US Exim Bank also, for example, in the late 90s and early 20s, there was a big discussion as to whether US Exim Bank should still exist. If it does so, then what will be the rationale, legitimizing? So all of these public financial agencies have suffered from this. And I don't think Chinese policy banks are an exception. So currently, these banks have been going through a lot of changes. And here is why the Chinese banks are currently suffering from, struggling to identify themselves in between the state and market. So here I'm going to illustrate the difference between export loans and overseas investment loans. This may get a little bit technical, but I think it will be easy to understand. Let's take a look at the firms. Okay? We know many Chinese construction companies are building infrastructure projects in different developing countries. Right? So when they just started their business, let's say in the late 1990s, they serve as, for example, suppliers, subcontractors of a project, right? And later they gain experience, they can become, the prime contractor of, say, a bridge project or a power plant project, right? And later they kind of, gain some market and become more experienced. Now some companies started to be operators, right? They run the project after they complete it. And even at the top, they can become a project investor. They invest in the equity shares, right? But when firms serve different roles, their expectation of the profitability of the project will also change. When you're a supplier, when you're a subcontractor, or even when you're a prime contractor, you don't really care whether the project as a whole will profit or not as much, because the project owner is the one that has to be taking care of this kind of calculation, right? You just build the project, you get paid, you leave, right? But once you become the project investor or some, even partly an owner, then you have to take into consideration, right? If the project doesn't seem to be profiting, then you probably take a step back, right? Let me think about it. Maybe I'm not going to do it, right? So if the case, increasingly as more Chinese firms become operators or project investors, their preferences for their collaborating financial agencies will change. If the project per se is attractive, it's financially viable, even financially profitable, they can naturally attract commercial banks, right? Why do they have to rely on public financial agencies, right? So increasingly, you'll see more competition between public financial agencies and private banks or commercially oriented agencies as firm interest changes. So this is something that's not just happening to China, and I'm going to show you some details of Japan, which is what I see in most similar case. This is something of a figure from Japan Bank, JBIC, Japan Bank for International Cooperation, which is Japan's Exim Bank. So starting 1955 to 2021, if you see the data of 1955, the vast majority of their overseas lending is export loans. But if you see 2021, the vast majority is actually overseas investment loans, right? Similarly, this actually shows a change from supporting export to supporting FDI, right? And that will actually affect the destination of where you land. This is also the same Japanese bank. You see that in around 1990s, 1980s, Japan, destination generally moved to the better off market. For example, you'll see a big chunk of North America investment, right? But that's not there in the 50s. Right? So as firms' preference changes, these banks' preference will also be changing, and the destination will also be changing. So what will happen to that? What will be the outcome of that is that you will see increasing competition between Exim Bank and commercial banks. right? And more importantly, policy-wise, there will be more discussion about demarcation. How do we separate aid from export finance? Because you want to avoid the scenario where you are overly using aid to subsidize your export finance. And this is actually what most OECD countries nowadays do things. For example, here is the OECD data of where most of their official export credit go. And you see that most of the credit actually goes to, there's a pretty high percentage of high income and upper middle income here, right? Whereas the low income and lower middle income are actually very small. In other words, OECD countries' Exim banks actually go to the relatively better off markets. Right, you naturally see a bifurcation. The Exim banks are increasingly going to better projects. Let's just put it this way, financially more profitable projects, right? So how about China? So I argue that currently China is going through such changes. This is official data from China's official insurer, Sinosure. So if you look at the different types of insurance that they provide, this bottom line is the kind of long-term export credit insurance that they provide, which has been kept kind of steady and then going down a little bit in 2018. But if you look at the overseas investment insurance, so this is the kind of insurance you'll buy if you invest directly, right? And this actually goes up. So this it's kind of estimation that shows that firms' preference, what kind of insurance they borrow, have changed a lot. And policy-wise in China, you see there's a lot of discussion, for example, as to how to calculate risk more cautiously, right? And also, Rebecca had this paper analyzing small and beautiful, right? So there's a lot of things has changed from lending largely to support the contractors in overseas market to more selective kind of lending, right? In that case, the banks as well as the firms will be more cautious in terms of determining what kind of project they will support. So that I think is something likely will be continuing going on as these changes goes on. So if you would like to hear more, you're welcome to pre-order the book. There will be more details there. Okay, thank you very much.
I kind of wish the same was true in the United States. Many in the US government and beyond seem to think that what needs to happen is we need to counter BRI. And beyond the sort of geopolitics, there are some concerns and some that Rebecca mentioned about debt and so on. China's state-owned enterprises do get the advantage of being, sort of a sovereign character, if you will, without some of the equity disclosure and equity requirements usually required around sovereign-to-sovereign debt, all while quite often armed with contractual provisions designed to protect private investors like home country sovereign guarantees, having one's cake and eating it, as you might say. So I think there are some sort of legitimate reasons for concern, but I think the US is headed off on a bit of a strange road, although it hasn't got very far, which brings me to this very odd picture that Boris Johnson orchestrated at the G7 in Cornwall. What was he thinking? Anyway, so at this G7 meeting, Joe Biden announced the response to the BRI, the Build Back Better World initiative, B3W for those into acronyms. Biden promised that it would help meet the enormous infrastructure needs of low and middle income countries. As one official put it, until now, we have not offered a positive alternative that reflects our values, our standards, and our way of doing business. The press release trumpeted that B3W would collectively catalyze hundreds of billions of dollars of infrastructure investment for low and middle income countries in coming years. Fantastic news. It was largely about mobilizing private finance for infrastructure, billions to trillions in the term of our friends up the road at the World Bank. So here's sort of what was happening with Google searches around the term Build Back Better World. The spike is indeed at about the moment that the G7 was building sandcastles on the beach in Cornwall. And you can see that, there is this brief spike, but it kind of falls back again. And it's worth comparing to global search interest in Belt and Road Initiative, always stronger. Even on the day that Build Back Better World was announced, more people were searching the term Belt and Road Initiative than were searching Build Back Better World. They tried to rebrand at the next year's G7. It became the Partnership for Global Infrastructure. That did not help. But what really didn't help was the utter lack of follow-through. About a year after B3W was announced, his administration's listed commitments to the cause of global infrastructure renewal added up to $6 million. Now, that's a bit unfair. There was a lot more going on than was enumerated in a pretty weak White House press release. The US Development Finance Corporation continues to do lots of investing, indeed has done more in the last years than previously. The Millennium Challenge Corporation is doing, $200 or $300 million a year, I guess, in infrastructure about. Some of what is going on here is in this picture, which has DFC in, is that teal? I guess I'm going to call that teal, and BRI in kind of gold. What's going on in the DFC teal? Some of it is infrastructure projects. Some of it in particular is energy. DFC was doing about $7 billion a year in 2022. We've heard that BRI has changed what it's been up to, but anyway, it was doing 96 billion in those years. And it is worth noting that of DFC investments, 6% of its total was in utilities in 2022. Now, look, partially all of this is about comparative advantage, right? Chinese companies are used to building lots of stuff and fast. Here is the high-speed rail network of China, 12 years apart. There's a lot more there than there is there. In the same period, the US high-speed rail network increased from a 50-mile stretch of the Northeast Corridor route to a 50-mile stretch of a Northeast Corridor route. So, it's not surprising, just in terms of comparative advantage, that Chinese firms and China is going to be better placed to support construction of infrastructure worldwide. And if you look at competitive awards of contracts from the World Bank open to bidders from any country, China won 2.3 billion in infrastructure contracts financed by the World Bank outside China in 2020, compared to the United States, 27 million. So, there is a comparative advantage story going on here, right? But it's also about the wrong financing tools, I think. Now, again, BRI has changed, but back in the day, it was largely about supporting the construction of what would become publicly owned infrastructure. That is a good tool if you want to finance infrastructure, because according to the World Bank, if you look at who finances infrastructure worldwide, 83% of the financing comes from the public sector as compared to 17% from the private sector. Infrastructure everywhere is overwhelmingly publicly supported. I would add that our tools for supporting private sector infrastructure don't seem to be working too well. This is a terrible picture, I'm sorry, but it's a picture of cumulative IFC and multilateral development bank investment in private electricity generation in countries over time. Sorry, in a given country over time. So, Panama basically got zero, for example. It was up to 150. This is per capita, so $150 per capita over there. Up here is basically, do they have more power or less than they would expect in terms of consumption, given their GDP per capita? There's a very close relationship between the two. So Panama, for example, actually consumes a lot less power than you'd expect, given its income. The point is, there is no relationship here. It is not clear that supporting the private sector to invest in energy and electricity projects leads you to have more power than you would have done otherwise. So it's not a terribly efficient mechanism trying to work through the private sector. In addition, all of the complaints that are thrown at the at B3W, sorry, all of the complaints that are thrown at BRI actually apply to development finance institutions as well. They have lower standards of transparency than public financing. They too have the backing of sovereign creditors, and they too tend to get paid back first when other creditors aren't. DFIs like the IFC actually keen to advertise to investment partners how much it is that they get preferential access to foreign exchange and so on. So they're kind of in the same route. But the bank actually, the US does actually have tools at its disposal that are really good at leveraging private finance to support public infrastructure. The World Bank, the African Development Bank, the Asian Development Bank, and so on. They basically, for every $1 of capital they have, they can lend out $9, and that's because they borrow those $9 from the private sector and use it to lend to governments. So here is this fantastic tool to match what the BRI used to look like, at least, and support masses of infrastructure. So why is it that we are not seeing the Biden administration do what the Trump administration even managed to do, which is ask for a capital increase at the World Bank? Well, this is a graph of US in teal and China in gold, their global GNI share. Their global GNI share, if you use purchasing power parity dollars of the world economy, this is, and their voting share at the World Bank. You will notice that one country does pretty reasonably compared to its global share of the economy in terms of votes at the World Bank, and another country doesn't do quite so well. This is true at the Asian Development Bank and so on. The US basically faces a choice if it wants to raise a lot more capital through the World Bank for development projects about whether it wants to keep the institution small but under Western control, or make it bigger, get more capital in it, and have the inevitable conversation about, well, what about capital shares then? And apparently the US has decided that their answer is, we're going to keep the World Bank small, thank you very much, and under our control. Which is perhaps why we have a new line from the administration on the Belt and Road Initiative, which is, don't need to compete. I actually think that's a real loss for developing countries, which need more infrastructure and benefit from more options on where to get that infrastructure money. I think it's also a benefit because, again, BRI is not a perfect model. But developing countries want finance, they want investment, and BRI is providing a lot of that. And meanwhile, the US bilateral response, I'm afraid, has been pityingly small and used the wrong tools, while the US multilateral response has prioritized control over volumes. And until that changes, I think the US response to Belt and Road remains a bluster rather than substance.
So some initial thanks for inviting me to this. I've been invited to this China conference in successive years. I'm not a sinologist. I want to put that out there right away. I'm more like our esteemed chair, Stephen, being a scholar of international political economy, although Stephen has much more China experience than I have. But I appreciate this. This is always my annual crash immersion course in China. And especially, I would say, it's gratifying to hear the latest from younger scholars, as we have heard throughout the day. I did want to flag one thing to the university people who are in the audience, which is where the pipeline of younger scholars is going to be 5 to 10 years from now, because there is a collapse in the number of American students studying in China. I mean, truly dramatic collapse since COVID, and it has not recovered. So if you're lobbying anything with the US government or your universities or with Chinese universities, it's to have more American students go to China. Anyway, enough of that public service announcement. There are no papers, so I was at a little bit of a disadvantage. 2 of the panelists gave me their slides, so they were circulated to me, so I based this on slides and what they've said today. And really, the panel's about the balance sheet of BRI on its 10th anniversary. Is it a happy birthday or not? And the balance sheet, first of all, think about where it started. It was a promise of large-scale, ambitious funding of infrastructure in the interest of connectivity. I noticed today there wasn't much talk about connectivity, and that is one aspect of the evaluation we might want to discuss a little bit. But in any case, As Rebecca Ray's excellent paper in discussion and the other panels have suggested, BRI has changed over time. And that's based on the statements of the Chinese government and based, as Rebecca has suggested, in actual evidence of how the BRI is being implemented. There have been successive shifts. Clearly, the move to an open, green, and clean BRI with the 2019 initiative, the effort to construct a BRI 2.0, as Data has described it. But some questions about these shifts for the panelists. First of all, is this a decline? And here there's a data issue, and it came up in Muyang's slide where she compared the data with the Boston University data. The Boston University data suggests that it's really kind of fallen off a cliff. And the data people in their report last year made it clear that they disagree quite explicitly in a footnote with the Boston University folks and how much it's fallen off the cliff. So I would appreciate, I guess the lesson of this, the transparency of the Chinese data is not great. And you have to do a lot of work to find out what's going on. But it'd be interesting to know how you compare these two sets of data, because how far it has declined in terms of actual finance that's being put out there into the world is an important question. Rebecca mentioned the shift to liquidity and the liquidity arrangements. I just want to make that's more my field, actually. I just wanted to make a comment about that because a lot of this shift, if you looked at her pie graph, is to entities that have never been used as actual lenders of last resort. That goes with the Chiang Mai initiative and even the Chinese bilateral arrangements, which are also, I think, more directed to expanding the role of the renminbi than it is to actually creating lender of last resort. That's a small point, but it's true that China has definitely expanded these arrangements. But in terms of decline, another piece of evidence is the 2023 Third Belt and Road Forum for International Cooperation saw many fewer heads of state and government present. There's a real drop-off in the attendance by European and Asian leaders. As Rebecca has pointed out and other scholars have pointed out, there's been a big shift away from mega infrastructure projects towards smaller projects centered on green development, digital connectivity, and other types of cooperation. My esteemed chair has written a book about the way that China learns from its experience. And I think one of the points that comes up in this shift over time in BRI is that China is learning from, if not mistakes, the shortcomings of BRI in its earliest manifestations. And you can see that in the shift that Rebecca Ray described. But let's talk a little bit about other report cards. Setbacks, poor reading of domestic politics in some of the BRI partners, particularly Pakistan, which is the biggest in the developing world. Myanmar, not going well. Sri Lanka to a degree. So the heavy reliance on local partners for assessing their own risk and their own political risk, as opposed to making an independent assessment of political risk in many of these countries. And many of the countries, as I think Rebecca's data pointed out, are pretty high risk. And that's one of the features, one of the benefits you could argue in part of the BRI. There's the question of the effect of domestic politics in China on the BRI, particularly during COVID-19. How did that shift things? The risks of investing in and doing business with China have grown, as unquestionably, even for advanced economies. The risks of economic coercion, which many countries, which came up this morning in some of the panels, apparent with Australia, South Korea, but the question is, do other countries, middle-income and low-income countries, are they concerned about that issue as well? And of course, there have been massive international changes, which really didn't come up so far in the panel. The sanctions imposed by the United States, which are threatened to get even heavier following the Russian invasion of Ukraine. And the debt restructuring issue, which I think is a very important, was mentioned by our panelists, very important one, where I think Rebecca pointed out very correctly that China is not the story, that the debt trap story is not accurate. On the other hand, China complicates debt restructuring because it's a new actor in an already complicated story. The fact that many low-income countries were able to access private financial markets for the first time means that when a country like Zambia tries to do restructuring, it's very complicated. It's no longer just a Paris Club story. And China, quite frankly, has behaved very much like any old creditor. It has not been particularly sympathetic to the case being made by many of these poor developing countries when debt restructuring. Stephen can speak to that. Our esteemed chair is an expert on this, and he can speak to that. So the debt restructuring issue is a very important point going forward, I think, for many, especially the low-income countries. Some final questions. kind of big picture questions. Where does it fit into overall Chinese economic strategy? The stories that we were hearing about this morning. If China really is intent now in its competition with the United States on technological upgrading, where does BRI fit in that story? I mean, is digital connectivity part of that perhaps? Or is basically it being degraded, demoted to a degree? It's of less significance to the top leadership than it used to be. Or is this shift to the green BRI, a way to support a set of new industries in China, the way it supported a group of old industries like cement and steel and the construction-related industries in the early BRI. There was no mention of the Asian Infrastructure Investment Bank. And how does that fit into the BRI? Because it has to maintain its independence as an MDB, but on the other hand, it's a Chinese-led MDB, and there has been a certain amount of co-financing in my understanding. So it'd be interesting to know something about that as well. Second big question, has the BRI expanded China's influence in the BRI countries? This is a big concern in Washington. This is maybe the obsessive concern of Washington. I would say there's very little evidence of that overall. I mean, if you look at the surveys that have been done by Pew, AidData, basically, there's a fairly benign view of China, but it's not like China has overtaken the United States in terms of positive views. It's not like China's gained a lot in terms of actual concrete specific influence, except as Audrey Wong has argued, I think correctly, in countries with governments of very low accountability and low transparency, like Cambodia, where BRI could be used in different ways to influence elites in ways that it could not be used in countries that are more open, more transparent, and shall we say, less corrupt, quite frankly. So China remains a big magnet economically, that's quite clear. But on the other hand, is there a declining appeal of China as an economic partner, as an investment location, as an economic model? And what does the BRI say to that? And a final big question, which Charles Kenny raises, which is how should the United States and other donors respond? Well, if you believe that the influence question is kind of a non-question, as I do, that really isn't a big issue, that China has not expanded its influence in any specific ways that one can identify because of BRI, then perhaps we can lower the temperature, or we could hope to lower the temperature in Washington about China's development finance. One could say you should not portray Chinese finance as entirely bad. You should do, as Rebecca suggests, I think, that you should encourage countries to de-risk the risks that come with Chinese finance and then take it. I mean, why not? It's good infrastructure finance. Or following Kenny's argument, given the dubious case that China is pursuing a unified and effective strategy, and I must say that's always the thing I like about these papers throughout the day, is you go down the street to the Capitol or other parts of Washington, China is this monolithic, unified, inexorable force. And you listen to the papers of people who know something about China, and you realize, what a mess. I mean, there's so many bureaucracies, and yes, they try to centralize, but you can just imagine Xi Jinping saying, I said something about that last year, and nothing has happened. So like all authoritarian regimes, it's a much more complicated process. And if it's not pursuing this unified, effective strategy of expanding its influence, the main goal should be mobilizing the vast sums of finance that are needed. And here, everyone is in agreement, the IMF, the World Bank. The sums of finance for the green transition in the developing world, especially low and middle income countries, is enormous. And therefore, we should take all the possibilities of getting that finance from any source to make that transition. And that should mean China should make a contribution as well as the United States and the MDBs and anywhere else that can make a contribution to this vast global need. But anyway, they were great papers, and I felt very, very topical. Thank you.
Thank you very much. Thank you very much to Miles. What he's made excessively clear through his skillfulness as a discussant is that in the 10 years of the BRI, this is an initiative that certainly has had an impact on a multitude of dimensions over the last decade. And perhaps in just a minute, for each one of our panelists, for maybe a minute, maybe two, you could take a piece of whatever sort of key dimensions that Miles was just highlighting that you want to respond to, and then we'll open it up for the audience for broader questions as well. But one thing too, just to note as your chair that might be kind of interesting too, is I think Miles ended with this really interesting question of economic influence, right? And one of the takeaways to some extent is, well, is the economic influence such that we have to worry about China or not, right? And so that might be interesting to hear people's reflections on that too.
I'll make 3 very brief points to leave enough time. One, I want to underline your call for greater data transparency. There is a difference between the way aid data tracks this and we do, primarily because they bundle in the use of the liquidity measures into development finance, and we track it as a separate data set. Both valid, we track them separately because if you're going to measure the impact or the effectiveness at meeting their goals, you do so separately, right? But certainly all welcome at the table, different ways of looking at it. The shift towards equity that I highlighted and then you highlighted is entirely unsurprising for an actor. We saw it with Japan too. Thank you for including that slide. That as firms get more experience abroad, they're willing to take on the equity risk. It matters to them now whether it's profitable or not. In doing so, this means we're more likely to see internal financing within China of Chinese firms going abroad in the same way that we saw it elsewhere. This doesn't mean that the BRI is over, that we would simply because it falls off of one data set, it enters into another data set, right? And again, more data transparency, please. We would all love to be simply downloading and analyzing someone else's data rather than making it from scratch. Believe me, I speak for all of the grad student RAs at all of the institutions who help with this. We can employ them in more productive ways, I promise. And then finally, in economic influence, that's where I cut my teeth in this field. What we specifically thinking about labor, environment, and other social environment, like labor, land, climate, and communities, that kind of policy that economic influence can have an outsized footprint with, we don't see it. We do not see specifically Chinese firms lobbying for state policy in host countries to change. We do not see Chinese companies predominantly evading or suing to change policies or suing to prevent changes with policy. We do not see a lot of ISDS interaction, investor-state dispute settlement. However, they're frequently engaged in the most environmentally and socially sensitive sectors and have not developed this kind of internal risk management structure yet. They're doing that now, right? So my talk is really about, well, we've learned some lessons. Let's see what happens next. I don't know what's going to happen next. Let's find out together.
Yeah, I say thank you so much for these very wonderful questions and comments. I guess there are so many to cover, so maybe just for the sake of is it working? Okay. Yeah. I was just for the just saving time, and maybe I'll just reflect on the last question about, has BRI increased China's influence in developing countries? I think the answer is yes and no, because for example, as Rebecca showed in her slides, many countries that borrow from China actually at the same time borrow from the World Bank and traditional creditors. So it's like for them there is like one more option to consider. And you're right in pointing out that for some countries, for example, if they cannot access other sources of capital, maybe Chinese capital could be their last source. So in that in those category of countries, then maybe China could have a stronger presence in terms of their total lending portfolio. But I think you're right in pointing out that increasingly development, international development has become an issue area that we, at least rhetorically, we see more contention between US and China in who is going to take the lead in, in driving development in the developing world. But my analysis is that actually, despite all these rhetorics, the overlap, the kind of project that Chinese and American companies are interested in doing are kind of different. So they have a different appetite in terms of what they will undertake. So if really they are going to compete, like the portion of project they're competing over is quite limited. But for the rest of the project, they will just pick the kind of project they prefer. So I see that it's more, definitely it opens up, there's possibility of competition, but there's also a lot of, filling the gap kind of story in international development. Yeah.
Thank you. That was fascinating. And I should yield back because most of it was to these. But just on the switch to equity, I think that's fascinating, partially because of what we're seeing China do in Africa now with manufacturing, which is, some manufacturing firms, largely at the sort of the low end of the manufacturing scale, but still are investing in Africa and creating jobs. And that's something that the IFC, the DFC, all of the Western DFIs completely flub. And it's largely because they've got, they have good standards on accounting and stuff like that, but it means they're just locked out of these markets. And also, frankly, again, it's a comparative advantage story that there aren't very many textile manufacturing firms at the low end in the United States. There are a fair number in China. As Chinese labor gets too expensive, it seems like a obvious strategy for those firms to move. They've got the kind of the skills, the expertise, and so on that Ethiopia needs in order to build its textile market. I think it's potentially really great news for low-income countries that this is going on. So I'm very hopeful. Just on the very quick the literature on aid and what it does to political influence, I've always found, fairly unimpressive. Ooh, it managed to move a UN vote. So it wouldn't be a surprise if the same was true with China.
I'll stand here. So thank you very much, both to Miles as our discussant and each of the panelists. It is now that time where we open up to the audience for Q&A. We'll take, as you might expect, we'll take them in packages of 3. 1, 2, 3. Start over here.
I'm Peter Humphrey, an intelligence analyst and a former diplomat. As we look at BRI, it has, of course, its geopolitical goals and its economic goals. And a huge debate is which is the bigger deal. I'm leaning toward geopolitics, and I'll give you some reasons why. It's very important to note that all these projects that China is pushing forth, maybe many of them are getting greener, but there's a whole slew of projects that are a complete disaster. The Ocean Railroad is a complete disaster. The Mekong developments in Southeast Asia, complete disaster. The Siem Reap new base in Cambodia, complete disaster. Every single one of the islands in the South Pacific is a complete expenditure of Chinese money with no recompense whatsoever. And the little bit of recompense they had, which was some fisheries, is now blowing back because Philippines declares that 2 of the fisheries have now been killed off by Chinese fishers. And you just cannot keep doing this if you want a comprehensive picture of these developments coming out of China.
And our audience member over there, I think the first one on some level is how much learning, right, has actually taken place from a Chinese perspective if there are these, questionable projects.
Thank you. Thank you to the panel members. My name is Monish Mahurkar. I work currently for an investment firm, but spent a number of years at IFC previously. So I wanted to raise a slightly different question. Most of the presentations were from a kind of an economic influence sort of frame of reference, competition for influence. But I also wanted to get your comments on whether this is also to do with the fundamental differences in the economic structure or economic model. So for example, for China, my view or my impression is that this whole BRI was also crafted during a time, and it's still the case to some extent, that China has a net excess of savings over investment, right? They've been trying, but have not quite succeeded in raising consumption levels. And so therefore the BRI was a way of exporting that excess capital, right? As much as about perhaps gaining influence. And the US is in a completely different position. The US still runs current account deficits and still has, a fairly dynamic investment kind of proposition right here. So that was one question. We could comment on that. And second, this whole thing about different sources of capital, which I completely agree with, which are needed, particularly for the transition. But from my experience at IFC, I also recall that one of the bigger challenges is not so much capital. There is capital sloshing around in different forms, public, private, mixed in the system globally. The challenge is developing capacity for meaningful bankable projects, which is often a bigger question, which I know multilaterals struggle with. And I'm sure the BRI initiative has its own challenges in that. Thank you.
Thank you. Finally, over here.
Thank you. One question to Becky and another to Muyang. For Becky, you described 3 stages for BRI with 2017 and 2020 as breakpoint. I was wondering why starting from 2017, they started to talk more about green, what necessarily led to that. And for Muyang, you talk about this whole transition to equity investment. So my direct question is that talking to a lot of these contractors like Sino-Hydro, they don't have any experts actually knowing how to do this investment. And if you think about a lot of the Chinese state-owned banks, they don't have capacity because they don't have experts knowing how to do this. So from your study of Japan, how long do you see this capacity to be taken, to build up?
Excellent. So each panelist will have about a minute to reply so that we can do, yes, a second round of questions. Go for
Thank
it.
you. I take your point entirely. My mic is off, sorry. I take your point, and that is exactly what I meant by environmental and social risks in the host countries are economic risks and diplomatic risks and geopolitical risks for China. And I think that is key to recognizing the development of the Green BRI, which of course is supporting leadership in their leading industries in the same way. That's how this business works. And so your point is well taken, but it drives into my point, I think, that these risks are interconnected and it is no longer possible to shunt risks to host communities into the kids' table. It creates endogenous economic, geopolitical, and diplomatic risks for everybody involved. It's in everybody's interest that we have Western and Eastern finance from all kinds of sources going for energy transitions and that they work. That's in everybody's interest. And so I'll leave it there to leave time.
We also have an institutional arrangement called the 2-finger. Not yet, after. Okay, so we will go there and then back around. Yep.
Yeah.
Linear again.
Yeah, thank you for the questions. I think I would like to echo what Rebecca said earlier about this, learning by doing thing, and then to what extent China has learned. I myself, as a researcher, also want to understand. For example, as you said, if there is a Chinese model, is this model going to work? And if we, the Chinese bank apply the same model to other developing countries, I think the way I try to answer myself is that I look at how this Chinese development finance was practiced in domestically in different Chinese provinces, and you do see a variation. In some Chinese region, for example, the coastal region, Southeast Asia, you see like a massive development over the past 2 decades. And the banks were very proud. They were like, we are the one to finance all of this economic development. But on the other hand, you also see some other regions, the same kind of model, the same way of lending just simply didn't yield the same results. So I expect the same kind of variation will be visible in other developing countries, given that so many, this goes back to Miles' earlier question, we need to take into consideration the host countries' political and economic institutions. Even if it's the same kind of development finance, we may see very different outcomes. And then the question asked by Ke Yi, like how long it will take for the Chinese companies and banks to learn to do these projects in a financially viable way. I think that's the question I actually asked my informants in those banks. I do see a strong learning process. For example, the notion of how you do project finance. Right, a lot of Western banks know how to do that, and the Chinese banks just increasingly learn to do project finance. But it's like for a long time, their projects are not financed in such a way. But I think, for example, you study energy sector and stuff. Many Chinese commercial banks are actually pretty much actively engaged in financing, energy projects that are financially viable. So I do see like there is a shift in terms of the way you learn how to do different financing with companies. In the past, they learned how to do contracting, but increasingly there is a big discussion among Chinese large contractors of this. In Chinese, it's called 投建营. It means like investment cooperation, construction operation, right? How do you do all of these things all together? So they are taking serious consideration into how they make such a shift. Yeah.
Just want to talk briefly about the bankable projects issue. I mean, at a time when interest rates have been high, the number of sort of shovel-ready infrastructure projects in developing countries have been going down because it is harder to make a financially sustainable solar power plant, as it might be, when interest rates are higher. And it does actually put us in the odd situation that, on the one hand, we need trillions in order to finance the green transition. On the other hand, the actual number of financially viable projects out there, for especially private sector, is going down, which might create a position of competition between development finance institutions for the few deals left. And it will be interesting to see how that plays out now that China is a much bigger player in that space, with the one hope and caveat that actually they aren't investing in all the same kind of projects. And so, maybe we can all learn to get along.
I think Miles also wanted.
On the first set of questions, that gets back to this question of the agency of the receiving government, because I think these projects were not forced on these countries by China. I mean, two of the cases you mentioned would be Laos and Cambodia, right? Two very poor, low capacity countries, corrupt political systems, and China doesn't ask a lot of questions, right? They would argue, we don't interfere in domestic politics. If this is the project you want, if you want a port on the South China Sea, well, that's great from our point of view. We'll build you a port in the South China Sea. But that does get to the question, Rebecca, you keep making ESG. Well, the last part of G is governance. Is China's change in greening the BRI also extending to governance issues? Because there have been some statements, I believe, about BRI in which corruption has come up, and we're not going to do corruption anymore, something like that. But do you see any signs of that? Because it seems to me that is the question. They don't ask questions about governance. And one of the reasons the World Bank fell out of favor is they did ask questions about governance, right? I think Charles would agree. So what's the status of that, I guess?
I would specifically point to the latest round of environmental and social reforms involve accountability to affected communities. They involve the CCCMC, the China Chamber of Commerce for Mining and Chemicals, has a new independent accountability mechanism. It's brand new, it's never been used, but on paper, it's up there with the good ones. The new requirements in the Green Finance Guidelines for information transparency and for community consultation and for grievance mechanisms within development finance projects. These are brand new policies and they haven't been put into place yet. I have heard that the National Financial Regulatory Administration is developing key performance indicators to be able to grade financial institutions on the extent to which they are following these guidelines. All of this is yet to happen. So I cannot say yes or no to you. I can only say that appears to be, specifically regarding accountability and transparency, appears to be the most recent chapter in reform. And I, like many people around the world, am holding my breath and hoping for the best possible outcomes for developing communities.
We have a few minutes left, and we're going to brazenly take two more questions from the audience. However, we ask that they are questions in the form of a tweet, very quickly, very direct, right here and right over here.
Thank you. My question is about China's. Thank you. My question is about China, whether China can expand its influence through BRI, which is something that Washington is deeply concerned about. My question is, I'm not sure if we should probably frame the question differently, which is, with so many countries being willing to join BRI, isn't that already a type of influence?
Hi, I'm as a person from the private sector, and I'm not going to ask for the geopolitical influence, diplomatic influence question related to BRI, but a simple question in like any private sector investment idea is, when you ask for a project for a finance, what is the economic return, rate of a return, and what's the return period? So I wonder if there's any research done on the economic return from the Chinese investors' perspective. The reason I think that's very important is because that related to the sustainability of the BRI. If it doesn't create economic returns, then I don't know how long it's going to last.
And as an academic, I was accused of tacting too much to the left. So I'm quickly going to take one more over here.
I got the mic. Sorry. Yeah. So I have two questions.
Ooh.
So, very impressive presentations. Thank you very much. I just saw the investment of the US in Angola in railway, 1.6 billion for the Lubito railway. You didn't mention that. What do you think? I think Mr. Kenny can have an answer on what is the US interest in the vital mineral supply chain, and also in the weight of China in the economy. You forgot to mention also that they have adjusted the SDR, the weight to include the Chinese currency. But when you say that they want a small World Bank instead of a bigger one, why is it that the US always gets to decide on this?
So each panelist has about a minute to reflect on these questions, and then we will have a break.
Sure. To the first question, very briefly, I'd point to the example of Honduras, who switched their diplomatic recognition to Beijing and almost came an inch from saying openly and explicitly, this is because we have not gotten enough power generation infrastructure investment from Taiwan and the United States. We have about a 50% electricity access rate in Honduras. It's very low for the Latin American region. It's more on the line of what you expect in sub-Saharan Africa. That's not okay. And our existing relationships have not delivered for our people. Therefore, we are going to diversify, right? It was very explicit. We have concrete deliverables that we need to provide for our electorate, for our constituencies. If we're not getting them, we will expand our options. And so it may simply be, in some cases, a sign that these decisions have already been made. And rather than expanding influence after joining the BRI, but simply we have pragmatic concerns that are not being addressed. Therefore, we will do what we need to do so that our people have electricity. It's a politics of the local response to your question, I suppose. To your question about bankability, I would simply say that we have a line of work that I didn't have time to get into here, talking about what we call China's coordinated credit space, with the idea that development finance institutions being publicly owned and working with state-owned firms essentially means they can take on projects that don't have an ROI on the individual step of the project, but have a broader ROI when it comes to making it easier for their investors to come later and work in this country. And so that's both the positive and the risk of this model, is that the ROI is not concentrated within one specific section of highway that has tolls. Rather, it means that an entire corridor of industrial development can happen and now be profitable. That China's not unique in this model, perhaps unique among major development lenders, but that would be it.
Okay. Yeah, so maybe I'll answer the question about the return of these projects. So I guess one challenge of evaluating the profitability of infrastructure project is that, for example, it takes very long to complete the infrastructure project, and then also what defines the interest. For example, if a Chinese company gets a contract, from their perspective, they're actually gaining. Because otherwise, the contract may go to some other contractors, and then they are expanding their overseas market. So from the bank's perspective, as long as it's bankable, it's not losing money. I think from the bank's perspective, it's fine, right? And then also long-term wise, there are possible social impact of these projects. If they, for example, if the banks finance an industrial park, and then there will be companies, coming to the industrial park and driving up growth. So I guess when we capture the Chinese development model, industrialization, urbanization kind of, go at the same time. So that is like a more complicated way of calculating, what are really the profits of those financial institutions.
Charles?
Yeah, the US is sort of dipping its toe back into infrastructure in a few places. It'll be interesting to see whether we get more than a toe. On past record, I'm not hugely confident, to be honest. Why does the US always get to decide what happens to the World Bank? Because it still, at the moment, has a shareholding large enough to give it 15% of the votes, and that's enough for a veto power. The end.
And that brings us to the end of this panel. Thank you very much to our panelists. It was a fun and lively discussion.